If you've been keeping an eye on the markets, you know that volatility is a fact of life for investors. The roller coaster of ups and downs can make even the most seasoned investors uneasy. But here's the good news. With the right strategies and mindset, you can not only survive market volatility, but also thrive. In today's video, we'll explore 15 incredibly detailed and actionable strategies to navigate market volatility with confidence. These aren't just quick tips, they're foundational principles to help you protect and grow your wealth, even in uncertain times. Let's dive in. This is Wealthvelocity. Here you create, protect, and grow your wealth fast. Stay calm and avoid emotional decisions. When markets fluctuate wildly, fear and anxiety can push you to make impulsive decisions, like panic selling your investments or jumping into speculative opportunities without proper research. Emotional decisions are one of the biggest threats to your financial health during volatile times. For instance, during the 2008 financial crisis, many investors sold their stocks near the market's lowest point, locking in losses. Meanwhile, those who stayed invested eventually reaped the rewards as the market recovered and reached all-time highs. Take a deep breath and remind yourself that volatility is normal. Avoid making decisions based on headlines or market panic. Keep your emotions in check by sticking to your investment plan. Understand that volatility is normal. Market volatility is not a sign that the system is broken. It's a natural aspect of investing, driven by economic cycles, geopolitical events, and investor sentiment. Accepting this fact is critical to maintaining a healthy perspective. Consider this. Between 1980 and 2020, the S&P 500 experienced an average intra-year decline of 14%, yet the market ended with positive annual returns 75% of the time. Study historical market data to understand that periods of volatility often lead to growth over time. Realize that downturns are temporary and part of the journey toward long-term gains. Revisit your financial goals. Your financial goals should act as a compass during uncertain times. Whether you're investing for retirement, education, or wealth building, aligning your strategy with your goals helps you stay focused and avoid unnecessary risks. For example, if your goal is long-term retirement savings, a short-term market downturn is unlikely to derail your plans. Conversely, if you're saving for a near-term expense, such as a house down payment, you may need a more conservative approach. Write down your financial goals and categorize them by time horizon: short-term, medium-term, and long-term. Adjust your portfolio to match your goals, ensuring you're not taking on unnecessary risk. Diversify your portfolio. Diversification is often called the only free lunch in investing because it reduces risk without sacrificing returns. By spreading your investments across different asset classes, sectors, and geographic regions, you can minimize the impact of volatility in any single area. For example, during the COVID-19 pandemic, technology stocks soared while travel and energy sectors suffered. A diversified portfolio would have balanced these extremes. Invest in a mix of stocks, bonds, real estate, and commodities to spread risk. Include international investments to hedge against domestic economic uncertainty. Rebalance periodically to maintain your desired asset allocation. Focus on quality investments. When markets are volatile, quality matters more than ever. Companies with strong fundamentals, such as healthy balance sheets, consistent cash flow, and competitive advantages, are more likely to withstand economic turbulence. For example, blue-chip stocks like Apple, Microsoft, or Johnson & Johnson tend to remain stable during downturns because of their established market positions and reliable earnings. Prioritize investments in companies with proven track records and durable business models. Look for businesses in defensive sectors like healthcare, consumer staples, and utilities. Avoid speculative or over-leveraged companies, which are more vulnerable to downturns. Avoid timing the market. The idea of selling at the peak and buying at the bottom sounds appealing, but in reality, it's nearly impossible to time the market consistently. Missing just a few of the best-performing days can significantly reduce your long-term returns. For example, an investor who missed the 10 best days in the S&P 500 over a 20-year period would have earned significantly less than someone who stayed invested throughout. Stick to a disciplined investment plan, such as dollar-cost averaging. Avoid acting on predictions or market timing advice from the media or social circles. Maintain an emergency fund. Having an emergency fund is your financial safety net during volatile times. It prevents you from having to sell investments at a loss to cover unexpected expenses. A well-funded emergency account ensures that your long-term investments can remain untouched, even during personal or economic crises. Save 3 to 6 months' worth of living expenses in a liquid, low-risk account, such as a savings account or money market fund. Prioritize building your emergency fund before making speculative investments. Keep investing regularly. Market volatility can create buying opportunities for long-term investors. By continuing to invest regularly, you benefit from dollar-cost averaging, which reduces the impact of market fluctuations on your average purchase price. For instance, investing $500 per month into an index fund during a downturn allows you to buy more shares when prices are low, boosting your returns when the market recovers. Automate your investments to ensure consistency, regardless of market conditions. Avoid pausing or halting contributions during downturns. It's often the best time to buy. Monitor your asset allocation. Market movements can cause your asset allocation to drift away from your target. For example, if stocks decline significantly, your portfolio may become overly weighted toward bonds, reducing growth potential. Rebalancing ensures your portfolio stays aligned with your risk tolerance and investment goals. Review your portfolio periodically to assess whether it aligns with your target allocation. Rebalance by selling overweighted assets and buying underweighted ones. Consider defensive sectors. During periods of market volatility, not all sectors react the same way. Defensive sectors like healthcare, utilities, and consumer staples often perform better during downturns because they provide essential goods and services that people rely on regardless of economic conditions. For instance, companies like Procter & Gamble, which produce household essentials, or utilities like Duke Energy, tend to maintain stable revenues even during recessions. Allocate a portion of your portfolio to defensive sectors to provide stability during uncertain times. Consider dividend-paying stocks within these sectors, as they often provide steady income and resilience in volatile markets. Use ETFs or mutual funds focused on defensive industries for easy diversification. Use hedging strategies. Hedging involves using specific assets or financial instruments to offset potential losses in your portfolio. This strategy is particularly useful during volatile markets to protect your wealth from extreme downturns. For example, gold and other commodities often rise in value during periods of economic uncertainty, acting as a counterbalance to declining stock prices. Similarly, volatility index, VIX ETFs, or options can provide short-term protection during sharp market swings. Add a small allocation of gold, silver, or other safe haven assets to your portfolio. Consult a financial advisor to understand the risks and costs of hedging with options or inverse ETFs. Keep hedging as a supplement to your core portfolio strategy, not a primary focus. Avoid overchecking your portfolio. Constantly monitoring your investments during volatile periods can lead to heightened stress and emotional decision-making. It's easy to become fixated on short-term losses, even if your long-term goals remain intact. For example, if you check your portfolio daily and see frequent fluctuations, you might feel the urge to sell during a dip, even if the market is likely to recover. Limit portfolio reviews to set intervals, such as monthly or quarterly. Focus on the big picture and remind yourself of your long-term investment goals. Use automated alerts for significant changes instead of manually checking prices every day. Stay informed, but don't overreact to news. Market volatility is often accompanied by sensational headlines predicting doom or boom. While it's important to stay informed, overreacting to every news cycle can lead to impulsive decisions. For instance, during the COVID-19 pandemic, initial reports caused panic selling, but many sectors rebounded quickly as the situation evolved. Follow credible news sources that provide balanced, fact-based analysis. Avoid making decisions based on fear-driven headlines or speculative predictions. Take a long-term view of the news and consider how events fit into broader economic trends. Seek professional advice. Navigating market volatility can be challenging, especially for new investors or those with significant assets at stake. A financial advisor can help you stay disciplined, assess risks, and adjust your portfolio to suit your needs. For example, during the 2008 financial crisis, many investors who worked with advisors avoided panic selling and instead rebalanced their portfolios to take advantage of discounted stock prices. Schedule regular meetings with a certified financial planner to review your strategy. Consider using robo-advisors for automated, low-cost portfolio management if you prefer a tech-driven approach. Don't hesitate to ask for guidance during major market events or personal financial changes. Keep a long-term perspective. Finally, one of the most critical strategies for navigating market volatility is maintaining a long-term perspective. Markets are inherently unpredictable in the short term, but they tend to trend upward over decades. For example, despite numerous corrections, recessions, and crises, the S&P 500 has delivered an average annual return of around 7% after inflation over the past century. Investors who stayed the course reaped the benefits of compound growth. Remind yourself of the power of compounding and the historical resilience of markets. Avoid making decisions based on short-term losses or gains. Stay focused on your financial goals and trust your investment strategy to deliver results over time. And there you have it, 15 highly detailed strategies to help you navigate market volatility like a pro. Remember, market fluctuations are an inevitable part of investing, but they don't have to derail your financial journey. By staying calm, diversifying your portfolio, and focusing on long-term goals, you can turn uncertainty into opportunity and emerge stronger as an investor. If you found this video helpful, please like, subscribe, and share it with someone who might be feeling uneasy about the markets. Let me know in the comments. Which of these strategies resonated with you the most, and how do you plan to apply it? Thanks for watching, and I'll see you in the next video with more money in your pocket.